Hello everyone, hope you are doing good. As our market is going up and up every day, and every one of you may be so much worried about the valuations or will the uptrend continue as our Nifty may hit our all-time high of about 26,000, and will it sustain the rally, or the fear of US recession and other geopolitics will play out and bring the market down. So all these confusions and concerns the investors are having. In this video, I wanted to tell you a few quick analysis, fundamental analysis, or the parameters which I use in fundamental analysis, wherein you can quickly understand whether the company is solid and should you look deep into that company even further. So first you have to have a quick screener wherein a few parameters which I tell here is looked into, and if it is really attractive or you find it better, then you can further analyze the stock and get into that stock. So we all are aware of PE ratio, price to book ratio, price to earnings growth, PEG ratio, then your ROCE, ROE, then PAT, earnings growth, book value growth, then debt to equity ratio, what is the current debt of the company, is it very high, the dividend yield, such parameters. But here I will not tell all these generic or well-known ratios, but we'll highlight only 3 of them. So debt to equity ratio is very important. So while selecting a stock, the debt to equity ratio should always be comfortably below 0.5 so that the company is able to service its debt. But the ratio here which I am discussing is not debt to equity. First is EV to EBITDA, second is the free cash flow, and third is not a ratio but a parameter which I always analyze, that the cash and cash equivalents available in the company. Now talking about EV to EBITDA. EV to EBITDA is a ratio wherein I have already done a video on that, detailed video on that. But if the ratio is below 10, really you should look at the stock, because the stock may be undervalued considering its enterprise value to its EBITDA. So this shows that the stock is kind of undervalued from that ratio perspective. Obviously you have to look into other ratios as well, but then this ratio is very critical, which people miss. So PE can be deceptive, price to book also many a times for IT companies and other companies may be deceptive, but EV to EBITDA is taking into consideration the debt, the equity, everything. So it is the real enterprise value to its EBITDA, profit generated. So it is very important and can be really looked at to understand the valuation of the company and then look into it. So EV to EBITDA less than 10 to 12 is fine, so you can look at it. Then second is free cash flow. What is free cash flow? Free cash flow is, we have explained various times in our earlier videos, but quickly speaking, free cash flow is the operating cash flow minus the capex. So operating cash flow, you will get it from the cash flow statement. Sometimes in some apps you get directly the free cash flow as well, but I suggest you to look into the financial statement of the company from the annual report, and in that you will get the, from the cash flow statement, from the consolidated cash flow statement, you will get the operating cash flow. Operating cash flow minus the capital expenditure. So capital expenditure also you will get from the cash flow from investing activity. In that there is a line called investments for plants, equipments, etc. So that is the basically the capex. So capital expenditure, the money which the company is spending to grow its business, to put up a plant or to spend for the new businesses, so that the company generates more business and then it generates cash flow from that business. So if the company is generating meaningful profit, then the free cash flow will keep increasing, wherein he's putting money but he's generating profit, he's putting money, he's generating profit. So if the profits are much more than what you are putting in, that makes a sensible way of investing in that company. Otherwise, if the one company is a highly capital intensive business and he's just spending, it's called cash burn. So it burns the cash year on year and there is no profit generated, or there is no sensible revenue and hence a profitability from the business, then there is no point of just burning the cash or reducing the cash equivalence. So again, coming from free cash flow, so you should have a good free cash flow year on year. It should actually increase, and you should have a stable 10 to 15% minimum free cash flow increase year on year, so that this free cash flow generates or makes the company bigger. Its book value increases, hence the stock price also goes up. So already we have discussed about the DCF, discounted cash flow model, wherein we project the free cash flow for a company for next 10 years and then discount it back to the present date to understand the net present value and then find out the intrinsic value of the company. And then that intrinsic value, after applying some margin of safety, you get the intrinsic value, and if that intrinsic value is much below the current market price, then you can definitely go and invest in that stock. So coming back to our topic, free cash flow. So that you need to see whether it is really generating. Many companies generate negative free cash flow, wherein they are burning the cash and they are not getting enough operation or operating cash flow from operations. So in that case, you are just burning the money and you are not generating profit. So that's a red flag. And I would say, even if it has got good PE ratio, good price to book ratio, but then it is not generating sensible profits, then that's why probably the company is undervalued and it is a value trap rather than a value buy. So it's not value investing. Now the third thing, as I told, cash burn. So where the cash is coming from? It's from cash and cash equivalents. So company has got cash in their bank accounts, then FD, then they have investments in mutual funds and other investments, wherein the investments fetch them returns. It can be in bonds also, stocks also, in subsidies also, everything. So those are called cash and cash equivalents, so which can be liquidated on an urgent basis and the company can use that for various things, including their future capex plans or planned expansion or their business expansion. So cash and cash equivalents should be a good chunk. Like in companies like Indigo, which they have got huge cash and cash equivalents, wherein it shows the strength of the company, the muscle power of the company. So some companies have huge debt to equity ratio, say 4 and all, just like Tata Motors, but then your cash equivalence is less and your debt is huge. It's a big red flag. If they have cash and cash equivalents and then they have taken a good debt, maybe they are getting the funding at better rates, so maybe it is good. But then if you have a big debt and you have a less cash equivalent or cash in your account, then it's a big red flag. So if the company is good, if you have got a good cash and cash equivalents, so it is always understood that the company, in case of emergency or business expansion, they don't have to go for big debts. They already have cash in their account and they can utilize that for expanding their business. So it's a buffer. So always cash and cash equivalents has to be a big value. There is no figure as such, but then you can compare it with the debt they are having or the equity they are having, and compare to that how much cash they are having. So we spoke about cash and cash equivalents, then we spoke about, and this cash and cash equivalents you will get from the balance sheet of the company, and we spoke about free cash flow, then we spoke about EV to EBITDA. So these three figures along with other generally known figures, if you compare, then you can get into a very small set of companies wherein they are very fundamentally strong. Then you can look into the business, what is the management, what are they selling, all those things. So in reverse also I would say that you can get into the company, you know about the company, then you can analyze these figures and then further dissect the company for probable value investing. So hope these three ratios you will keep in mind while analyzing the stocks going forward. And maybe the market is at all-time high or almost reaching the all-time high, but still, as I told, index is one thing and your portfolio is another thing. As I mentioned in the last video, there are still various companies having good valuations and still coming under the category of value investing. So if these ratios are applied with your due diligence and intelligence, then I'm sure that you will filter out better companies, and still in this overcooked or so-called highly overvalued market, you will get value buys and cheap valuation companies wherein going forward they can be multi-baggers. See you in next video. Till then, happy investing.